Well, so inflation continues to move higher. Surprise, surprise, I'm sure to any of you who tune into this channel. But it's pretty notable that today we got the CPI data from March. It's up 3.5% year over year, higher than expected, a hot inflation number. We can see from CNBC here the chart of the year over year percent change, and you can see, especially there, not in the core CPI, but the just headline CPI beginning to really tick back up off of the lows of the past few months, starting to look like it's moving higher off of this bottom. And the headline CPI is the number that matters if you like to buy things like food and fuel and housing. So that's a pretty important number to look at. The core CPI also higher than expected. But really, the notable thing about this move today is that despite the fact that inflation is higher, and that's putting a huge damper on markets, it's reducing the expectation of easy money from the Fed. The idea of a June rate cut now out the window, but still, look at silver. Silver is in the green. This is important, folks. Markets across the board, all the major stock indexes deeply in the red. Russell 2000 down almost 3% today. Look, even gold is in the red today on this higher than expected inflation print here. Crude oil happens to be in the green as well, just like silver. We'll talk about that in just a few minutes because that's going to keep heading higher. But it's very important to note here that the price of silver is showing itself to be very resilient. Now, if we look at the price action on the day, you can see that actually there was this kind of sharp dip right there when the data came out, right when markets opened early this morning. However, that was met by a flurry of buying. You actually saw the price head pretty much well into the green following that. Now it's come down a little bit, but staying in the green. And again, that's very notable considering the fact that just about everything else is selling off heavily in the light of this inflation data. Of course, inflation is going to continue heading higher. We're going to talk about geopolitics here and how that contributes, but it's always important to note that the real driving factor behind this rising inflation is all of the deficit spending and the debt monetization by the Federal Reserve. The massive expansion of the money supply, the QE, all that stuff takes a while to work its way through the system, and we're continuing to live with that cumulative high levels of inflation. Now, I was hoping we would get a little bit of a dip today in the price of silver. I mentioned that yesterday, a buying opportunity if we were to get this high inflation print, but it looks like you had to act pretty quick because that dip in silver only lasted for a few minutes. Excuse me. If you do want to get some silver, though, today, and I do still view this as a good entry point considering how strong silver is showing itself to be in face of this high inflation, make sure you check out sdbullion.com, today's video sponsor. There's a link down in the description. Right now, they still have junk silver, $214 for a $10 face value roll. That comes out to be about $30 an ounce. Not bad when silver is at $28.15. Still pretty good premiums, if you ask me. I do think that junk silver, this stuff right here, this is going to be one of the first forms of silver to really, really take off when retail investors move into this market in earnest, which isn't quite here, but I do believe it is right around the corner. Let's talk a little bit about this inflation report and just how bad things are getting here, and why this is ultimately not going to be a bearish factor for gold and silver, or really even for paper assets, the markets, at least in terms of their nominal value. This is from CNBC again. It's a breakdown of the report, and we can just get some ideas of, what is up the most. So food at home, they say up 1.2% year over year. That's a pretty good example of how these numbers are manipulated and massaged to disguise reality. I mean, put a 1 in the chat if your food bill has gone up a lot more than 1.2% over the past year. But even within these cooked numbers, you can see beef roasts up 11.2%. Baby formula, that's a pretty important one there, up almost 10% year over year. Frankfurters, for those of you who like a sausage, 6.2%. Lettuce, up 5.8%. Sugar, up 4.3%. So, I mean, this is all pretty important stuff. Of course, they leave this out of the core CPI. They say that food and energy, they're too volatile. But the reality on the ground is far from that. Look at this. Okay, video discs and other media. I don't know who still is buying video discs, but if you are, they're going to be a lot more expensive. Motor vehicle insurance, 22.2%. Repair of household items, 18%. I mean, you get the idea. Insurance is up across the board. The cost of replacing things up across the board. Inflation is a persistent problem. It's not going anywhere. And, here's the thing. There's a lot of talk about what the Federal Reserve is going to do next, right? This is the CME FedWatch tool. Following today's hot inflation print, the percentage of market participants anticipating rate cuts in June has dropped precipitously. Markets now only factoring in a 16.5% chance of the Fed cutting rates. Maybe the Fed will have to push off rate cuts in the short term. Of course, if they really wanted to fight inflation, what the Federal Reserve from here would have to do is hike rates. Delaying rate cuts is not enough because they've been delaying the rate cuts, and what's happening? The inflation is moving higher. So, 5%, 525 basis points might not be enough for the federal funds rate. And I mean, how much would they have to hike rates? I think that probably more than a quarter of a basis point, right? They'd have to get in there and aggressively hike rates to actually combat inflation. What's the problem with that? Well, the whole economy would likely collapse. Even with just the anticipation of the Fed delaying rate cuts, look at what happened. This is a headline from today. 10-year Treasury yield jumps back above 4.5% after March inflation tops estimates. Now, let's look at that. The 10-year yield. This is a critical factor here. The interest rate on the 10-year yield now up to well over 4.5%. Huge sell-off in bonds today, up 4.26% on the day following this report. This is a good example of why the Fed is going to have to cut rates. The 10-year yield, it's a benchmark rate. A lot of stuff is based on it. Mortgages, other interest rates that derive the cost of borrowing money from this 10-year U.S. bond. Not to mention the fact that, the U.S. federal government is paying now over $1 trillion annually in interest on the ballooning national debt. And the higher the yield on these U.S. treasuries go, the higher that number, it's going to trail. It's not going to be immediate because the debt has to roll over. But the debt is continually rolling over, and that means that number is just going to continue to skyrocket. The interest on the national debt, if we see, several days like this, it's not going to take long before the interest on the national debt is the single biggest expense on the federal budget, even exceeding Medicare and Social Security. It's already exceeded defense. So, this is an example of why the Federal Reserve, not only are they completely incapable of hiking rates. Can you imagine if they did that? What would happen to the banking sector? What would happen to the commercial real estate sector that already has like $1 trillion worth of debt rolling over this year because the holders have been kicking the can down the road trying to wait until rate cuts. But the rate cuts, people think they're not coming. They're coming. Oh, they're coming in a very big way. Look at the 10-year yield rising. Think about the banking crisis that we had back in 2023. Let me pull up the 1-year chart of the 10-year, and you can see that was a banking crisis at Silicon Valley Bank that was triggered by rising yields on U.S. treasuries. Every time this number goes up, the losses on the regional bank balance sheets, the regional banks who are sitting on these piles of low-yielding U.S. treasury notes, the higher this number goes, the greater the unrealized losses on those portfolios are. And you can see we are now well above where we were just 1 year ago. During that crisis. So yeah, this is going to trigger something breaking. I don't know what it's going to be. Is it going to be a bank fails because they're forced to realize losses on some of those bonds? Is it going to be because banks like New York Community Bank Corp end up having to write off debt that is based on commercial real estate properties, which really are not worth what they say they are on paper, and they end up having to, mark those properties to market and write off billions of dollars worth of debt? I don't know. I mean, it could be something else, right? It could be one of these black swan things that just comes out of left field. The thing that we do know is with huge amounts of debt in the economy and rising interest rates, it is a recipe for a disaster. And the only way that the Federal Reserve can solve these problems, at least in the short term, is by slashing rates or by driving down the yield on U.S. Treasuries by getting back into the market via QE. Now, are they going to call it QE? Probably not. I mean, I'm sure that it'll depend on what kind of, crisis they have to blame things on to give them the cover that they need to begin printing. But certainly there's plenty of pins out there that could prick this bubble. And let's change gears and talk about crude oil here real quick. So this is from April 8th, from 2 days ago. We saw oil prices fall after Israel reduces troop presence in Gaza. Okay, so to briefly recap what's going on with oil, last week there was a warning by the CIA that there were imminent reprisals headed Israel's way. I mean, I think what they said on Thursday was that there are going to be attacks within the next 48 hours, right? That was what we heard. We saw the price of oil spike following that announcement. Shortly after that headline hit the presses, saw the price of oil spike up over 87 bucks. You can see that here. Okay, then you got this announcement that Israel was withdrawing some of its troops, or the majority of its troops, from southern Gaza. There was a lot of speculation out there about what exactly was going on. Was it that the U.S. was putting pressure on Israel to avoid a major conflict with Iran? Of course, the U.S. doesn't really want that because we're in an election cycle, and the inevitable spike in crude oil will likely lead to much bigger inflation problems. And, as you saw today with the CPI print, inflation is already a very significant problem. But that was a very brief reprieve, it seems, because all of that talk of, seeing peace, the de-escalation between Israel and Iran, I mean, I really don't buy it, and I don't think that investors are either. I think that's why crude oil is catching a bid today. Once again, even though the price had come down. I mean, look at this. This is from this morning. Israel threatens to strike Iran directly if Iran attacks from its territory. Israel's foreign minister threatening that his country's forces would strike Iran directly if the Islamic Republic launched an attack from its territory against Israel. So, yeah, here's the quote. I mean, it's pretty straightforward. If Iran attacks from its territory, Israel will respond and attack in Iran. So it doesn't seem like there's much, de-escalation there to me. Also, Iran has been reiterating, the Ayatollah Khomeini threatening that, or with this very bellicose rhetoric, reiterating that they are planning to retaliate for the Israeli strike last week, which killed 2 top IRGC commanders. I mean, that's the thing that really kicked all of this off into overdrive in the first place. And it seems like there is some hesitation on both sides, but it could just be that they are preparing. And today, we got yet another warning from U.S. intelligence here, according to Bloomberg. This is from just about an hour ago. U.S. sees missile strike on Israel by Iran and proxies as imminent. Okay, so, I mean, hopefully this doesn't play out this way. I just want to say that. Sometimes people say, oh, you're reporting on this like you're gleeful. No, I'm very concerned about this, actually, and I hope that things don't play out this way. But that being said, I can't ignore the fact that it looks imminent that we're going to have a large-scale regional war in the Middle East. And I mean, the price of oil is going to absolutely explode if that plays out. What's that going to do to inflation? Well, it is going to drive inflation much, much higher However, there's a few things you have to consider here. One, this is going to be a scapegoat for the powers that be. They're going to be able to say, no, the spike in inflation has nothing to do with all the money we've created. It's nothing to do with Federal Reserve monetary policy. It's all about this war in the Middle East. I mean, you remember in 2022, we had Putin's price hike when inflation was hitting 9.1% year over year. Now, the problem is that we're going to have inflation spiking this time around, but we're going to have it occurring against this backdrop of severe economic weakness. I mean, if the price of oil spikes up, that is going to lead to a recession around the world, very possibly, because the cost of doing business and just about everything is going to increase. You know, all goods will rise if the price of oil spikes. And how high could oil spike? Well, just consider this, that the Straits of Hormuz flow there right next to Iran, immediately adjacent to them, and 20% or so of global daily oil production flows through those straits. So if Iran decides to mine the straits, to use naval forces and missile strikes to shut off the straits, if they decide to try to embargo those straits one way or another, and we've already seen how effective the Houthis in Yemen have been at pursuing a strategy like this. Well, imagine if a major nation state like Iran gets involved. That's going to drive the price of oil sky high. And that, of course, won't be acceptable to the folks in Washington and, powers that be around the world. And so it's very likely that the U.S. is going to get drawn into this conflict as well, which is going to lead to much higher inflation due to all of the spending that likely will be poured into this conflict. And also, I think we very well could see this being a setup. Now, this is highly speculative, obviously, because there's a lot of moving parts here, but this is the sort of thing that could give the Federal Reserve the cover it needs to begin running the printing presses again, despite the fact that inflation is higher, right? I mean, what better excuse than war and a massive recession brought on by spiking oil than to run the printing presses? I mean, what better cover could you have for that action? I think the Fed has to be very circumspect about how they behave here, because to some extent, the population is aware that they have something to do with inflation, despite, a massive PR campaign to obfuscate the true causes of inflation. That if you don't believe that's going on, I mean, the fact that they redefined the word inflation over the past 50 years, I think should give you a clue as to what's going on here. But yeah, I mean, look, a broad scale regional war in the Middle East is going to be massively inflationary. And yet, what are we seeing today? We're seeing inflation ticking up. In the past, this has been a very negative thing for the price of gold and silver. Gold in the red today, despite the fact that it has been on an absolute rip. But look at silver. People are buying silver despite the fact that inflation is up. And, that's important on so many levels, because it tells you now, maybe when the headlines hit today that, inflation was higher and you got this spike down. Maybe it was the algorithmic trading bots that were selling off, but somebody came into the market and started bidding this stuff back up. And that is a different dynamic than much of what we have seen over the past months and years. And look, someone said in the chat here, CPI could be even higher next month. Yeah, probably will be. And despite that, I think silver is going to continue moving higher. I mean, the fundamentals for silver really couldn't be better right now. A huge inflationary backdrop, an economy in shambles, a potential financial crisis. I mean, we saw what happened to the precious metals when the banks started to fail last March. That was just a trial run, if you ask me. And we're very fortunate that we got that warning, because I think anybody who's paying attention is probably getting into some physical hard assets. I mean, I'm not telling you what to do. This isn't financial advice, but I have been buying lots of silver since that time, and I think that that's going to pay off in a very big way. But let me know what you think in the comments down below. Let me know what you think about inflation and the price of silver in today's very interesting dynamic that inflation is moving higher, and yet the price of silver is holding on in the green. Thanks for watching, everybody. Do me a favor, smash the like button, share the video, subscribe to the channel if you haven't done so yet, and I will catch you next time. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.